It's Sunday, April 15th, 2023. Welcome to the All About Your Benjamins weekly mixtape for the RLS Wealth Rundown. And actually, you're probably seeing this on the 16th, but we're recording this on Sunday. Hope you had a great week. It was a beautiful week here in Indiana. Today, not so much, which is why I'm in the office, but you better believe I maximized my time in the sun working outside as much as I could from the patio or coffee shops or tables outside, soaking up in all that beautiful sun while I can. So let's get to the headlines that may or may not be impacting your financial plan and portfolio. And in my notebook, I just have a few things written down to cover, so let's get to them. The first one, with inflation where it's at and the Federal Reserve always in the news talking about wanting to get inflation down and looking at employment numbers and all those things. The latest metrics coming out with the labor market show that while the labor market still remains strong, it might be cooling off a little bit. So as I look at the numbers, we added 236,000 jobs, new workers last month, which is historically a strong number, but it's the weakest number in 2 years. So the economy continues to add jobs, but it's adding at a slower rate, which may be enough to give the Fed some comfort to pause in the next rate hike meeting. Doesn't mean that'll be the rocket ship going up for the market, but would be nice to see them pause. I think we're getting close. So the numbers coming out of labor markets are showing that unemployment is sitting at around 3.5%. So still historically kind of low, getting closer to some averages, but we have some more room to go, I think, to get a definition of a recessionary unemployment number, which is one of the things the Fed's looking for. So we'll keep an eye on the employment picture and see what that tells us. Remember, it's always lagging. This number was last month's number, so it's not telling us where things are today, but where it was last month, but it is the best that we can do. Speaking of that, going into inflation eased to going up 5% over the last year. So from March to March, we saw prices go up by 5%, which is a lot lower than the 8s and the 9s and the higher numbers we were seeing. So we're seeing inflation continue to come down. In February, it was up 6% year over year. So we went from 6% to 5% in a month's time. So that is a move in the right direction. So hopefully that will continue and be able to set us up for maybe a little bit of just pause from the Fed. Things calm down in the markets, just get to a little bit of a complacency, maybe even a little bit calming down, maybe not complacency. Complacency is usually not good. Calming down in the markets, calming down in the economy, calming down in the headlines, just a break for a little while before we march back up and go up and to the right for the long term. So inflation looks to be coming down, so again, hopefully that gives the Fed an opportunity to pause the next time they meet. All right, this has nothing to do with the economy, but I found it's an interesting article. 1 in 3 active managers in the large cap growth space were able to beat their benchmark. So that means 2/3 of active fund managers are not beating their benchmarks in the large cap area. So large cap growth, that is one area of the overall market that you could be investing in. If you have a diversified portfolio, you probably have some of that, but you want to have other areas. I bring this up only to remind us how hard it is to do better than just the market. So you hear a lot of debate in the investment world about active versus passive. Is one better than the other? Part of it just depends on your time and your preference and your ability to put in the work to make it happen. Doesn't mean that you can't outperform. It doesn't mean that you can't do better picking stocks. It's just harder. And it's even harder to pick active mutual fund managers. So if your thought is, I can't pick stocks, but maybe that guy or that woman can, let me put my money in their active fund, there's no guarantee that they're going to do better than if you just put it in an index fund. So all of you at RLS Wealth, our style is to have just index funds, but have some tilts built in. Small cap tilt, value tilt, momentum tilt. Putting a little bit in these other areas, still using low cost index funds to do it, but just give us exposure to those areas and let the market do its thing rather than try to pick stocks or pick funds. And then that allows us the ability to go focus on things we have more control over, like doing things to increase our savings ability, doing things to increase our income earning ability. And those are things that really have a bigger long-term impact on your financial plan, your portfolio, and your success rate, less about this fund versus that fund. Finding a way to increase your earnings so you can increase your savings is a bigger impact to your plan than a little bit of outperformance by active fund managers. So, doesn't matter if you have the active fund or not. Just an interesting thing that I thought I would share, reminding us that sometimes we don't need to make things overly complicated. Stick to something a little bit more simplistic that's easy to understand, easy to manage, keep it cheaper, and then focus on the things that you can control the most. All right, and the final one is we are getting into earnings season. So first quarter earnings are going to be coming out in the stock market, reviews and not reviews, but companies announcing those. So over the coming weeks, surely there will be some headlines of some misses and some surprises and stock prices going up and the market moving around. A lot of headlines, a lot of noise, a lot of distractions to come from that. So you'll pay attention, see what's going on. If you have a favorite stock and maybe you have a little bit you have in a fund account, pay attention to that. But going into earnings seasons, always a lot of headlines, but it will tell us a little bit about how are companies across the globe, but specifically in the US, holding up with everything going on. The expectation is we're going to see earnings continue to come down in companies with cost of wages going up, with cost of debt going up, with interest rates going up. So all of these forces working against it in a slowing economy. So we're expected to see earnings come down. We'll just see if they come down faster or harder than expected. All right, that is all I have in my notebook. So we'll let you get to the rest of your day. Enjoy the rest of the rundown below. If you have anything specific you would love to see in, or some things you want me to talk about on future ones, send them over. Send me a question and I can address them in the mixtape next week as well. So we'll have a section maybe at the end for questions from the readers or the viewers. I can address those at the very end after I hit whatever headlines that come up this week. So with that, thanks for tuning in as always. Have a great week and we'll see you all in the next episode.